When timing meets opportunity, fortune favors the bold. Meet Shakey's Pizza Asia Ventures, a company that's set to deliver rapid expansion and profitable returns with industry-leading practices. We recommend a buy rating for pizza with a 1-year target price of 13.6 pesos and a 39.5% upside. Our buy conviction is back to buy. Above peer earnings growth driven by expansion, strong track record and ESG commitment, and relative undervaluation compared to peers. Pizza has cemented its 50-year-old legacy brand Shakey's Pizza as the #1 full-service restaurant in the Philippines. The company has since diversified its brand portfolio with profit-accretive acquisitions, including Peri and hyper-growth kiosk chain Potato Corner. Pizza's revenue is 70% restaurant sales supported by franchise fees and merchandise. The company is able to capture both offline and online demand with its extensive store network in both mall and non-mall areas. Standing on the shoulders of Filipino consumer giants Century Pacific Food Incorporated and Universal Robina Corporation, pizza is set to grow into the shoes of a food service powerhouse. First, supersized earnings growth driven by Shakey's and Potato Corner. We expect a 24.1% earnings CAGR in the next 5 years, driven by upbeat sales growth and margin expansion. We forecast a total revenue CAGR of 14.9%, 65% is attributed to store expansion, and 35% to same-store sales growth. Favorable economic conditions indicate that the Filipino is ready to spend. A strong labor market into the next year will bolster private consumption, which historically accounts for 75% of the country's GDP, ensuring sustained demand for pizza's products.
Pizza's impressive 15% top-line CAGR is set to outpace the industry's 12%, aided by their domestic and international expansion given their asset-light and franchise model. We project Pizza to annually deliver around 28 new stores for the full-service brands and 210 branches for Potato Corner, increasing total store network by over 59% by 2028. We expect Pizza to execute its plans of increasing presence outside of Metro Manila and underpenetrated regions that are exhibiting standout growth. And we expect Pizza to continue to expand Potato Corner abroad in top markets like Southeast Asia, fulfilling the company's vision of a potato corner in every corner.
Alongside store network expansion, earnings growth will be driven by gross and operating margin expansion of 3.5% and 7% respectively by 2028. Easing inflation and normalizing global commodity prices this year will drive down prices of key ingredients, boosting gross margin to 26% by 2028. Further supporting bottom line is an increase in operating margin underpinned by its capex-light model that leads to improved operating leverage. Pizza is also able to pass on its OPEX to franchisees, leading to higher operating margins than if it did not have franchised stores. Pizza's capex-light model will fast-track the delivery of new stores, boosting profit growth and generating an average annual free cash flow of 2 billion pesos. As it stands, Pizza's operating margins and FCF conversion rates are already the highest in the industry, and we are confident that they will remain so, positioning the company for both agile store rollouts and potential acquisitions. Second, we have strong conviction in Pizza's long-term success, given its shared management's outstanding execution track record and ESG commitment. Pizza is helmed by the Po and Gokongwei groups, who manage market-leading brands under CNPF and URC, the country's leading canned food and snack food manufacturers respectively. Their unparalleled expertise in the consumer space drives the success of Pizza's in-house and acquired brands alike. Management is still able to grow legacy brand Shakey's through its omni-channel strategy, menu innovations, and loyalty programs. Shakey's has remained the runaway market leader, with market share growing from 2015 to 2022, in contrast with its main competitor Pizza Hut, whose share declined. Newly acquired brands have thrived under Pizza, with around 900 new stores established since acquisition. Potato Corner alone has opened over 800 stores, leading with 15% share last year. We expect these profit-accretive acquisitions to contribute 49% to earnings by 2028.
CNPF has an award-winning ESG program that balances both risk and performance. Pizza's shared management with CNPF allows Pizza to adopt leading governance practices. As such, we are confident in management's ability to deliver excellent ESG programs, supported by the company's ESG framework, People, Pizza, and Planet, which is grounded in the UN SDGs.
January 2023 marks the fourth year of Pizza's net zero plastic waste commitment. To note, Pizza and its sister companies are the first local group to adopt this practice. In terms of waste management, Pizza only produced under 20 kilograms of waste for every million pesos of sales in 2023, which is 91% lower than the average of its local and regional peers. Pizza leads the industry with its inclusive employment programs when 6% of Pizza's total workforce are people with disabilities and out-of-school youth. Pizza also uplifts the Filipino community through its franchising opportunities and collaborations with local farmers.
Third, we believe that pizza is currently undervalued relative to both domestic and regional peers. At a 15.3 times PE, pizza is currently trading at a 15 and 71% discount from domestic and regional peers, respectively. At our target price, pizza will be trading at an implied PE of 17 times, which is much closer to the domestic average of 18 times. Backed by an impressive 24.1% net income CAGR, its P to G of 0.7 times offers a significant discount from the domestic and regional averages of 1 and 3.3 times, respectively. As such, we believe that the price level of 9.75 pesos per share is a highly attractive entry point. Now, pizza leads all peers in terms of 5-year forward EPS growth. We'll see increases from 0.64 pesos in 2023 to 1.88 pesos in 2028. We'll also expect to see increases in ROE of about 5% to 18.5% by the end of the forecast period. We believe that pizza's 17 times implied PE is justified given its substantial earnings potential. Now, we expect pizza's cash conversion cycle to end at negative 2.2 days for 2024. Its operating margin is already ahead of most peers at 15.1%, and we'll expect to see increases to 18.1% by the end of the forecast period. Now, these increased efficiencies will translate to an FCFF CAGR of 24.7% to the end of the forecast period. This growth indicates that there's significant headroom for the company to fund its expansion and exceed its current goals. Now, these margin increases catalyze our revenue CAGR of 14.9%, which is forecasted using a mix of the industry growth rate and historical GDP to revenue ratio. Now, this ties in pizza's revenue with the Philippines' economic growth and reflects pizza's brand equity. Now, we expect Shakey's to continue to take up a majority of revenue, while Potato Corner will see its store network expand by over 1,000 branches into 2028. We'll see its revenue contribution rise to over 34% by that period.
We conducted a valuation using a discounted cash flow analysis using a weighted average cost of capital of 11.3% and a terminal growth rate of 3% based on the target inflation rate. We calculated the target price of 13.6 per share, which represents a 39.5% upside, resulting in a buy recommendation driven by the aforementioned factors of market leadership and store and margin expansion. We conducted a sensitivity analysis and Monte Carlo simulation, sensitizing variables like revenues and costs, which resulted in the sell occurring only 3% of the time, showing that the risks are asymmetrically skewed towards our upside and strengthens our buy recommendation.
With all that being said, we do recognize that pizza faces inherent business risks, out of which we have identified 3 key risks to our buy recommendation. First of all, pizza is exposed to fluctuating commodity prices, particularly in chicken, cheese, and potatoes, given that raw materials are 57% of its direct costs. To address this, pizza can afford to use pass-on pricing strategies. The company also effectively handles costs through long-term contracts with suppliers, inventory covers, and its in-house commissary, which has led to sustained profit growth even in inflationary environments. Even if our estimated food inflation rate doubles, our share price still results in a 22% upside. Second of all, aggressive expansion may lead to sales cannibalization and lack of quality control for branches. With its versatile store formats, Potato Corner still has room to expand in over 1,300 locations, well above the expansion target. Our projected new store rollout for Potato Corner must fall short by 42% before shifting to a sell recommendation. To control brand image risks, management's increasing frequency of restaurant audits will ensure consistent brand equity across stores. A 50% year-on-year increase in marketing expenses will still result in a 28% upside. Lastly, persistent price pressures may result in anemic consumption. However, pizza has a track record of growing its revenues even in high inflation environments, supported by its revenue-driving strategies. We calculated that it will take a 13% decline in revenues before we change our recommendation to a sell. With its 24% earnings growth potential from store network and margin expansion, unparalleled execution track record and ESG commitment, and undervaluation compared to peers, pizza is the next big stock to watch out for. Come and share a slice of success with pizza.
You mentioned that the company's growth outpaces its peers, both locally and regionally, combined with superior margins. But what do you think the market's missing out on?
Okay, I'd be happy to take this question. So we think that the market is overlooking pizza for three main reasons. Number one is that it is a small cap stock. If we compare it to larger, more liquid names like Jollibee, URC, and CNBF, pizza's market cap is around 6% of that. And we acknowledge that in times of economic downturn, illiquid stocks will perform worse than the more liquid names. However, based on our thesis and our outlook that the market will turn around within the latter part of the year, we see that more liquid names like pizza will be the biggest gainers. Second is that the market is overlooking pizza's ability to execute its aggressive expansion. So last year, pizza was able to deliver 368 new stores above its initial target of 330. And based on our own estimates, we're actually being conservative. We're estimating around 220 stores a year when we know that the company can deliver 300 to 400 stores. And finally, the market is underestimating the strength of Shakey's consumer base, given the high inflationary environment. However, we see that Shakey's, or pizza rather, has a resilient core consumer base composed mainly of upper to middle income classes who are less price sensitive.
If I may, you showed us revenues with substantial growth, and you showed us margin, which is also growing. What is the reason for maybe not ever, but for a margin that grows above current level and continues doing so at the same time with revenues growing? And my another question or second part of that question is how does it transform to your DCF assumptions? Because if you have ever growing margin and ever growing revenues, and if you continue doing so after the 10-year forecast period, then the company, the world might be actually too small for that company.
Yeah, so there are two main reasons as to the margin expansion. One is as they expand rapidly, they're able to improve their operating leverage and unit economics, as seen here, where labor and occupancy makes up a smaller percentage of their sales over time, resulting in an increased margin contributions. The second is the franchise model. With the franchise model, they're able to expand and incur or generate revenues rather from their franchisees from the sale of merchandises, royalties, and franchise fees without having to incur a lot of additional operating costs. And as for the second question on the margin expansion, moving over to slide 94, we can see that the margin expansions we don't really think it's that unrealistic, because these are margins that they have experienced in prior years based on the graph here in 2018 and 2019 in particular, which is pre-pandemic. And over time, you see that it does start to taper off a little more as our growth slows down given the current expansion plans.
Thank you. So first, I love pizza, so it's a little difficult for me to be critical, but I will. But my question relates to your valuation, mostly driven by two considerations. First, the ownership structure. I guess pretty much a small portion of the shares actually float. And then secondly, with it being a small cap stock, were there any considerations or discounts that you considered from a liquidity standpoint for a company like this?
Yeah, if we could go to the trading volume slide, please. Yeah, well, for the most part, we're not seeing trading volumes yet at pre-pandemic levels, right? So it's not just a function of it being a small cap stock. It's also a function of the fact that the Philippines is still coming out of the pandemic. If you look at your slide here, the PSE, the Philippine Stock Exchange Index, and the pizza are not seeing the same volumes that they've seen pre-pandemic. So we're expecting to see greater volumes moving forward. We're expecting to see rate cuts later this year, early next year, and we think that will drive more trading liquidity, especially for the 20% minority stakeholders that you mentioned.
And sorry, just follow-up question on that. Did that influence your valuation of it, or if it did, how much did it influence, or if not?
Yeah, so one of the ways that we calculated our, let's say, our cost of equity, right, which is the beta, we use a regression analysis for the price and the price of the stock index, which we think already implicitly includes the other risks like that trading liquidity. But we did also conduct a sensitivity analysis on what could happen to their weighted average cost of capital, and even a 100 basis points increase in the overall weighted average cost of capital will still result in a hold, showing that there's still a lot of buffer in between the stock itself.
I think across Asia, we see a lot of F&B companies try to offer a multi-brand strategy. Given the company's growth and track record and execution, where do you think in terms of relative valuation, they deserve to be valued?
Sorry, can we clarify if we're looking at relative to other peers?
Relative to peers, yeah.
Right. Well, so what we're seeing right now is a company with stellar brand equity, and we believe that doesn't really carry, especially with the rest of the peer selection that we went forward with. For example, Shakey's its core business has been around for over 50 years, and we still see its market share going to this day. Potato Corner is a little newer business, came out in the 90s, a relatively replicable model, but at the same time, they've essentially cornered that part of the market. So for the most part, we don't see competitors getting to this level of brand equity that Shakey's has accomplished.
What do you think of the market? How far are we from market saturation?
Right, if we could go to the feasibility computation in terms of their expansion. So we've done a feasibility computation on the places where they could expand. So about more than 30% are in malls, and then around 60+% are in non-mall locations. And we were able to derive, using very conservative estimates, that there is enough room for expansion in the Philippines. So currently they could expand to 564 malls, but our estimate is only around 388. So this shows that the expansion of Potato Corner, or at least it's still underpenetrated in the Philippines. And we also have to take note that we don't think that they will reach market saturation because there is still even bigger room for expansion abroad in international markets. So we would like to add more context regarding expansion. We mentioned two things, domestic and international. Given domestic is we want to maintain the 85-15 ratio we have for domestic and international expansion. As you can see here, we have domestic, we studied expansion outside of Metro Manila because we wanted to consider market saturation. If we compare the three islands in the Philippines, Luzon is the major, it's the main. Going south, we see Visayas and Mindanao. They do not share the same saturation of restaurant outlets per 100 square kilometers. And success factors for pizza, actually, compared to other outlets in the food service industry, both in kiosks and for pizza chains, they are leading when it comes to store network. And this helps a lot with their prime mover advantage. And being a full service restaurant in the Philippines, especially in the province, their stores become landmark locations, a space for functions and events. And outside of the metro, we can see cheaper rent and labor in provinces, and pizza is currently aware of the advantages of continuing their expansion domestically. That's why they're investing in teams outside of the metro.
Regarding more long-term situation, do you feel any risk? Do you feel any change regarding food habits and its influence on the company?
Yes, I'm happy to start off this question. So if we go to online behavior that we see with pizza, they are 60-40 split with their channels. 60 is dine-in and 40 off-premise. The 60% will resurge, especially after the pandemic waned in the Philippines when the lockdowns were no longer common. Pizza remains, pizza as a company, they have omni-channels. They are available hotline. They're available through apps. They're available in food aggregators as seen on the screen. GrabFood and Foodpanda are the top two in the Philippines. And their products are one of the top food products ordered online, especially in 2022, as shown in the survey. So Shakey's Pizza has been able to maintain their market share, in fact, because of their quick adaptation to technology. And hence, their Shakey Super app, seen on the screen, they have around 1 million Android users only for Android and another million for Apple. So we're confident in their abilities on their online channels.
To add to Alex's answer, in terms of consumer preferences to the kinds of products that pizza is offering, pizza, fries, chicken, these are universal products. Everyone loves chicken, pizza, and fries. Shakey's has been around for 50 years and is still the market leader in the full service industry. We do recognize that moving forward, there's a push towards healthier food. In the long term, health can be a trend. However, Shakey's has been making it a priority to make their foods healthier. So they were actually the first restaurant in the Philippines to offer a vegan pizza. So this shows their commitment towards staying with the trends.
Despite the inflation in Philippines coming off, there's also some evidence of perhaps some consumption downtrading. How do you think the individual brands will actually fare in this scenario?
Okay. So we don't think that the prolonged inflation will severely impact demand for pizza's products, given that, again, their core consumer base is composed of upper to middle income class consumers who are less sensitive to price hikes. So in fact, we did a channel check where we compared the average menu price hikes to system-wide sales growth. We saw that pizza, despite hiking menu prices by around 3%, still maintained a record high system-wide sales growth last year compared to QSRs whose core consumer base are from lower income classes who have less disposable income and are limited in terms of how much prices they can hike, as well as other full-service restaurant competitors who do not have the same brand equity that pizza does.
Contextualizing my teammate Kara's point when it comes to consumption, in the Philippines, S&P reported that it will continue growing around by 5.5% in 2024. And if we can see on the right, the household final consumption expenditure categories, restaurants and recreations saw the most gain, especially after the pandemic. And we see this continuing. So we see no other reason that this wouldn't continue. The momentum of restaurant and recreational expenditures would not continue in the next year.
So this question is regarding their franchise model, in particular, since the company's built a lot of brand equity. Can you talk a little bit about how they are able to communicate and kind of translate that through to franchise owners as opposed to corporate stores? But what are some of the ways they're doing that, and I guess would do that as they grow?
So I think a best example of how pizza showcase their franchise partnerships is through their international expansion. Because we would like to compare that Potato Corner is a kiosk, sells flavored fries. That's not something that's something we've heard of before. And if we can look at their success factors as to why they're able to do that, they're an award-winning brand. They're global, renowned for being a global franchisor. Their products are halal certified and they have a lot of different flavors. Their proactive research and development team makes sure that different flavors in different countries have that cultural fit to the taste and the palate of the consumers there. And their strong franchisee partnerships and building the international teams to be able to operate, to have a strong infrastructure even outside the country. And lastly, they also have a promising reputation as a Filipino brand, with Potato Corner bringing the Filipino name across as they expand around the world.
I would like to add on to Alex's response to this question. So they have been doubling down on their store audit frequency. So this covers both company-owned and franchise stores. And because they have been increasing their frequency of audits, they are able to maintain their brand and equity in terms of food service and quality. And this ensures that,